So, you have a trust. You've done the right thing, you've planned for the future, and you think that your family's inheritance is safe. And you've put your home, what is the most valuable asset for most Americans, into what feels like a legal fortress. But what if I told you that that very trust is the one thing that could make the bank call your entire loan due? We're talking hundreds of thousands of dollars due immediately. And it's all because of one sentence that's buried deep in the mortgage and that most people have no idea is even there. The good news? A powerful federal law gives you an exception. Today, I'm going to show you exactly what it is and how to use it. So don't go anywhere because this is going to be one of the most important videos when we're talking about your real estate and your estate planning.
Okay, let's go.
So what is this ticking time bomb in the mortgage? Well, it's called the due on sale clause, also known as an acceleration clause. And basically what it does is it gives the bank the right to demand full repayment of the loan should you transfer ownership or sell the property without the bank's written permission. And I know what you're thinking, but I didn't sell my home. All I did was move it into a trust to protect my family's inheritance. And yes, in some way you're right, you didn't sell the home, but you did transfer ownership of the home. You see, to actually put the property into the trust, you have to sign a deed from yourself over to the trust. So as far as title is concerned, the trust is the new owner. Even though you control the trust, it's still a separate entity from you. You're just controlling it. And for a lender, this transfer of ownership can set off some alarm bells. So why do banks even have this clause in the mortgage? Well, it's not just to make your life difficult. It actually serves two main purposes. The first is to mitigate risk. You see, the lender gave you a loan based on your financial picture, not the trust. And again, even though you're the one controlling the trust is still legally considered a separate entity from you as a person. So now they're looking at a completely different financial picture than they would be if it was still in your name. Second, and this is probably more important for the business side of it, but it prevents the bank from being stuck with the same old low interest rate mortgages. You see, if you have an interest rate at 3% right now and you can just hand it off to somebody else, the bank doesn't have an opportunity to issue a new loan at today's interest rates. So the due on sale clause basically allows them to hit the reset button. The real panic here is the consequence. If the clause is triggered, the bank can demand the full balance of the loan paid, no matter what the balance is, whether it's $100,000 or $600,000, and they can demand that it be paid within 30 days. And if you can't pay it, then they get to initiate foreclosure proceedings. So the very tool that you use to try to secure your family's future is the one thing that can likely lead to a financial disaster, all because of a simple clause that you probably ignored or didn't even know existed. This isn't some imaginary monster. This is a contractual right that the lender has. So after hearing all that, you're probably tempted to go to your office drawer, pull out the trust documents, and throw them in the shredder. But don't panic. There is a federal law that provides a shield for American homeowners in this specific situation, and it's something that you absolutely need to know about. This protection is called the Garn-St Germain Depository Institutions Act of 1982. Congress passed a law to solve this exact problem after lenders in the high inflation 70s and 80s started aggressively calling loans due for minor transfers. The law basically tells lenders, not so fast, you can't enforce your due on sale clause in certain common family and estate planning situations. The Act lists 9 specific exemptions, but the one that matters most to us today is transfers into a living trust. Federal law says a lender can't call your loan due for a transfer into an inter vivos trust in which the borrower is and remains a beneficiary and which does not relate to a transfer of rights of occupancy to the property. So let's translate what that legal jargon means. An inter vivos trust is a trust that you create while you're alive. A standard revocable living trust fits the bill. The key rules are the person who took out the loan must stay a beneficiary of the trust. And the transfer can't be about giving someone else the right to live there. When you move your primary home into a revocable living trust, You are typically the creator, the manager or trustee, and the beneficiary all rolled into one. So you're still living there, you're still paying the bills. In the eyes of the law, absolutely nothing has changed. So for a lender, they can't actually use this transfer as a reason to demand repayment of their loan. This is your aha moment. This is the legal safe harbor that allows you to do smart estate planning without risking your mortgage. The Garn-St. Germain Act overrides the lender's due on sale clause in this situation, and it gives you the peace of mind knowing that your investment is safe. If breaking down complicated real estate topics like this is helpful for you, do me a favor and hit the subscribe button and the notification bell. My goal is to provide you with clear information that will help you achieve all of your real estate goals and protect your family's future. And by hitting the subscription, it helps me reach more people and empower more people. Now, knowing that this act is out there and it is a shield for you is one thing. Using it correctly is another. The protection offered by the act isn't a free-for-all, and it doesn't work for every property, and it doesn't work for every type of trust. The details matter a lot. First, let's talk about the Revocable Living Trust. This is usually the most common trust that we see out there, and it's the one that offers the full protection of the Garn-St. Germain Act. In a revocable trust, you keep total control. You can change it or cancel it at any time. Because you're still the beneficiary and live in the home, the law sees it as a change in legal form, not substance. The due on sale clause can't be triggered. This is the go-to strategy for most homeowners wanting to avoid probate. But things get trickier when we move to an irrevocable trust. Just like it sounds, this is the type of trust where everything is permanent. Once assets go in, you generally can't get them back. Since you might not be the only beneficiary or might give up control, lenders are much more likely to see this as a true transfer that triggers the due on sale clause. The protections offered by the Act get a lot murkier here. So before moving your property into an irrevocable trust, speaking with your lender and getting written permission is not only a good idea, but it's essential. Otherwise, you're just rolling the dice. Next up, let's talk about LLCs and investment properties. Everything that we've discussed so far has been mainly for your primary residence. The rules for investment properties are a little different. If you transfer a rental property into an LLC for asset protection, the Act exemption will almost certainly not protect you. The law is designed to help homeowners, not commercial investors in this scenario. So the transfer to an LLC is actually an ownership change, and it can trigger the bank's due on sale clause. Finally, this leads me to the most practical step. If you are planning on transferring a property into a trust, notify your lender. So even if you are making a transfer that is fully protected by the Act, as we've discussed, the best thing you can do is notify the lender and let them know what you're doing. You're not asking for permission, you're just giving them a heads up. So the best thing you can do is write a formal letter, let them know what you're planning to do, and include the trust documents that show that you are the beneficiary. This helps prevent any confusion later when they see a different name on the tax bill or on the insurance, and it avoids all the panicked phone calls. So let's tie this all together. You've worked your whole life to build what you have, and you want to make sure that should anything ever happen to you, it's passed on to your loved ones in a smooth and easy manner. The fear that a trust could mess all of that up is completely valid. That due on sale clause is a serious tool for lenders, but it's not unstoppable. The main takeaway for most homeowners is this: federal law gives you a clear and strong exception to this rule. It allows you to transfer your mortgage property into a revocable living trust without any fear of triggering the bank's due on sale clause. Your trust doesn't have to destroy your mortgage. When done correctly, it protects you, your assets, and your family's future. You have the power to protect your mortgage and keep your family safe. It's just all about knowing the rules and acting intentionally. While this video gives you the essential framework, everyone's financial situation is completely different. This video is meant only for educational purposes and should not be taken as legal advice. The best thing that you can do in your own situation is contact a trusted estate planning professional who can give you the proper guidance for your situation. To help start the conversation, feel free to click the link below to schedule a one-on-one strategy call with me. If you need an estate planning professional, I have several that I can recommend. And again, if you found this video helpful, please subscribe to the channel, hit the like button, and make sure that the notifications are turned on. We'll see you in the next video. And again, let's make sure to protect your family's assets and your family's future.